So Todd, that was a great question. A lot of people ask this question. Can you split the investment between two entities and still get the 200K bonus for February? And the answer I've been giving, but correct me if I'm wrong, everyone else on here, is like if you're investing with an entity, then like it's easier to say for people who are investing in their own name. Like if you're investing in your name, Todd, and someone else, your spouse is investing in their name, and you're filing your taxes jointly, there's a section in the PPM that says that we're filing jointly. You can put both of your names on it and you're still individual. Now, if it's two entities, then I believe the answer is no, that if it was each an investment in two different entities at 100K each, then each would get the 100K bonus, but not the 200K bonus. But correct me if I'm wrong, anyone else on the screen. Now, Todd, I'm assuming, are you the owner of both of the entities you're asking about?
Yeah, that's a good question, because if it's the same person and you're just using entities to invest, I think we would be willing to extend that out. But I think before using entities, we should have Rex cover LLC investments ahead of time. I think that's a worthy place to start.
Okay.
But yes, if it's the same person just using different entities, we will definitely extend that side letter.
If they say they're disregarded entities in that sense, that makes sense. But then Rex, you can touch on the effects of investing through an LLC.
So specifically, the code section 469C3 specifically states that your liability cannot be limited. And if you invest through an LLC, although that's a very, very common practice of our subscribers, upon examination by the IRS, you do run a potential risk of having your IDCs and bonus depreciation reclassified to be subject to the passive loss rules. That is, it's a very gray area, but that is a possibility. So typically what most individuals do is they invest as an individual, and then once all of the funds are expended, then automatically they convert to a limited partnership status in January of 2024. And at that point, most people, once they are reclassified from a general partner to a limited partner, they contribute their partnership interest to an LLC. And that's our recommendation.
And I'm going to see if Jeff, if you're on here, and Mary, if you're on here, because they both asked me that question of how does that work. Well, there's a lot of people. I don't see all their names initially. There's a lot of people, but yeah. So Mary and Jeff, if you are on, I hope that answers your question. Okay, so I see a lot of people on now. So I'll just do like a high level introduction and then we'll go back to the Q&A. So for those of you who just joined, this is the investor Q&A for the Diversified Energy Fund. And so we have Rex and Eric here. They are on the executive team of King Operating. They're the operators of the energy fund. And then Patrick from Invest on Main Street and me, Sarah, from Sugo Capital. We're on the advisory board for this fund. So we're all here to answer your questions. I see most of you already have an investment reserve, so that's perfect. What we're going to do today is answer all your questions. You guys have been asking the same questions over and over. So whatever question you have that has not been answered by me, put it in the Q&A right now. And we're just going to go through today and we're going to go through all of them. We're going to get all your questions answered. And the reason we're doing this is because it's hard to have, hundreds of one-on-one calls, but you guys have such similar questions. It's also good for your due diligence. Even if you're not ready to go now, you can get to know the team for a later date because we're going to be working together in the future. So Patrick, why don't you give like the elevator pitch of this investment, even though I'm looking at these names, everyone already has a reserve except for a few people, but could you give the elevator pitch of this? Because I like how you have so many parallels to multifamily, which is where most of these people have been investing.
Right. So Sarah and I are both multifamily pals, and we have been growing our multifamily portfolio substantially over the last decade. And one of the things that I realized was that more and more of my investors became heavier and heavier in the vertical of real estate. When, if you looked at some of Sarah's marketing materials, you see that the high income earners and ultra wealthy are closer to 50% to 25 to 50% diversified into alternative assets, which include real estate as well as other kinds of investments. And Sarah is now joining us and some others to provide what are alt assets, ones that don't correlate or rise and fall together with real estate. Investments that provide tax advantages, cash flow, and appreciation. In fact, this one's very similar to the structure of a multifamily deal, but it's in a different essential need. The government subsidizes housing, food, and energy. And it just so happens that in multifamily or in real estate, we get tax incentives. But for the most of us, we can't use those tax advantages to offset ordinary active income, like W-2 income, K-1, active, passive, all of it. In real estate, they limit that unless you're a real estate professional, which is very difficult to do if you're a high income earner as an officer, business owner, lawyer, doctor, those kind of things, because you're busy at your high income job. Unless you're a real estate professional, you can't draw those losses to offset ordinary income. Just so happens in energy, direct oil and gas drilling, the government heavily subsidizes that in a way to stimulate domestic production of natural gas and oil. In a way where if you invest in, for example, this fund, most of our investors, and of course you got to talk to your CPA, financial planner, and attorney, we're neither of those. But if you invest, you could realize as much as a 30% of your investment as just a tax incentive. You invest 100 grand, we should be passing through it at least a 75% paper loss in the first year. Different than multifamily, that 75% will reduce your taxable income. I'm simplifying here. I'm sure Rex can go into the specific codes. But what that means is you invest 100 grand, you're right, all in at 70 for most of our investors. And unlike in multifamily, you invest 100,000. Well, if that was ordinary income you just invested, you've actually got to make 130,000 because you still have to pay taxes on that. But in order to invest 100,000, right? Because you have to make enough to invest. You also have to make enough to pay taxes on the money that you came in. So this allows us to actually make 100,000 ordinary income, put that 100,000 to work. So you're kind of all in at 70K, right? Because the government kind of gave you 30 of it. Then you stack on the fact that, well, this is a cash flowing asset. We're looking at cash flowing in quarter two. And we've seen substantial cash flows come from these in prior funds. We've seen north of 10 and even 20% come out of these funds. And this one's projecting a 14 to 21% monthly passive income on average over the hold period. It's a little bit bumpier ride than the stabilized multifamily apartment that Sarah and I are used to. But if you look on average, on aggregate, it's not your grandma's annuity. Average and aggregate, you're going to get some really substantial cash flow that's also tax advantage. We get not only the year one paper loss, but then Rex helps to pile on like multiple different types of tax incentives along the way. Intangible drilling costs, and then depreciation on tangible assets like we're used to in real estate, as well as depletion. Depletion means now we're using natural gas and oil. We're depleting reserves. We're making profit from that. The government's like, look, I'm not going to tax you on that. You're doing what I want you to do. We're investing along the side of the government, right? We have all these incentives help to offset your passive income through the investment. And then, like in multifamily, we have a return of capital through typically a refinance or something. We're trying to model that. It's a little different. We're trying to model that by doing a return of capital where it's a development. We got these leases. We're going to build a bunch of wells, right? And as we build the value, we're going to carve out a piece of that. We're going to sell it. And then that's how we're projecting to get a return of capital in years 2 or 3 down the line. And then we're going to continue to develop all these leases throughout different areas where we're building wells, diversified fund, until we can get the rest and exit in 3 to 5 years. A similar kind of aggregated growth, cash flow and appreciation. And then on the backside, we're working on a 1031 exchange vehicle. should allow you to sell and then trade those forward, just as if it's real estate. Little known fact that the like kind rule has an exception. We're exchanging into oil and gas interests. Again, if you're investing with the government, they're going to get you, the wealthy invest to not pay taxes. And so here we are right now talking about how to do that and to diversify in the same way. There's no plans to even have debt in this fund at present. What does that mean? That means we're not going to be rolling through the roller coaster of real estate like we are. We're not going to be in a compressing, resetting potentially situation where there's deals, but they're harder to find. And the stock market's down. So where can you invest where things are appreciating? Tax advantage, cash flow in a market that might not always be down at the same time. Energy is one of those, like today. Energy's up, future's bright. So that's kind of and we can talk a lot more into the diversification, the product mix, natural gas and oil, but those are some of the parallels to multifamily.
Yeah, I love it. Thank you, Patrick. So I'm seeing that people are jumping on. Please use the Q&A and we'll answer your questions. So Patrick just gave an overview of the investments. So we're going to use the Q&A function instead of the chat, because once we answer them, we can, click it's answered and we can go through them. I'm going to give an overview on some of the just technical things that I see common questions about. How long is this? Like some people are saying, hey, is it liquid? Can I pull my money out when I want? No, it's similar to multifamily syndication where your money goes in and you can't request that your money comes out after a year or after 2 years. You have to wait until the exit of the fund, which is projected to be at year 3. There's questions around how are the returns calculated? So Patrick hit on this a little bit, but there's a cash flow component. And so some people are saying, oh, is the tax advantage part of the cash flow component? No, it's not. That's not calculated in the returns. The 3x equity multiple. So a lot of people are saying, how does that happen? Is that taking the tax advantage into account? No, it's not. So if you invest $200,000, there's a cash flow component that will happen every month. You get a check. Like Patrick said, it's not consistent, but the goal is to be around 14% per year. When does it start? It starts around month 3 or 4, to be conservative, guys. And then after 3 years, when the exit event happens, that's when there is the percent of profit that is shared with investors and shared with King Operating. And that's how the cash flow plus the share of profit at the exit is how that 3x equity multiple is derived. So there is a common question I got, Rex. At the exit, is there a recapture of the tax advantages? So similar in multifamily, if you invest 100,000 and you get a 50% depreciation and loss in year 1, so now your basis is 50K. So when you exit and you have that gain, that advantage is you kind of pay it later. So is this a get rid of your tax forever, or is this a defer your tax type situation?
This whole situation is a deferral. Of course, $1 of savings now is worth a lot more than $1 of savings 3 years from now.
Totally.
But there is ordinary recapture on the IDC and the bonus depreciation that is taken. But ideally, what will happen is the gain will be broken up into 2 parts. One will be a component of ordinary income, and then the second component will be deemed to be, to really get technical, a Section 1231 gain, which is taxed at capital gains rates. Also, as Patrick pointed out, we're working on issuing a 1031 product towards the 3rd or 4th quarter of 2022. I'm sorry, 2023. I'm doing 2022 tax returns, so please excuse me. I've got 2022 on my brain, but that 1031 program would allow individuals to roll the gain into a tax-free exchange, and that would permanently defer the tax on that transfer.
Would it also defer the recapture?
Yes.
And I just want to add a little bit to that, because I get this question a lot and people are, well, it's not real, it's fake, they take it back. Well, let's go back to you invest 100,000, The government, for most of our investors, are giving you 30 of that and not charging you taxes, right? So you've got 30 grand, it's not even your money, right? You turn that 30 grand if our equity multiple plays out to 90 grand, right? Well, sure, they're eventually going to want to recapture some of the funds that they lent you for this deal, but what have you done with it in the meantime? Tripled it, right? There's a lot of upside. If you didn't participate in the 1031 exchange for whatever reason, then you could have an ordinary income, as Rex was saying, but then you could reinvest it into another fund like ours that provides an ordinary income offset, right? So even if you didn't participate in the 1031, there's still a way. Certainly there's some recapture, but you've done well with the government's money while they've given it to you, right? So it's a net gain, but then you could reinvest in another fund like this and still avoid that. So try to offset that ordinary income. Is that right, Rex?
Most definitely. And Eric, explain our future funds for a moment, if you don't mind.
Yeah, this is fund 2 in a series of 8. So over the next coming 7 years now, time's flying by, but between now and 2030, we have a plan of getting to 10 billion in total assets and valuation over 8 funds. So we will definitely have a home for future allocations from the fund, whether they're from a divestiture or a full exit. There will definitely be another home in oil and gas for you.
Okay, awesome. Because I see that was a few of the questions. And on the tax, I'm looking all over because I'm looking at Q&A in chat. Try to use Q&A, everyone who's in the chat. But I do see some tax things. So hopefully Rex just clarified it. But the question of the 75% tax write-off for the first year, is it in 2023 or 2022? Well, if you invest in 2023, it's for 2023. If you knew King before and you invested in 2022, then it's for 2022. So it's the year you made the investment.
Mm-hmm.
And can you talk more about the exit? I see some questions like, so it's a 3-year projection on the exit. Explain, what is the exit? When is the decision made?
Sure. So there's 2 of them in our style of fund. So the first one is, and kind of quick overview, in our process of acquiring properties and then raising capital and then drilling wells to produce income and developing PUD locations for future drilling, all of those activities raise the value of the property. So as we're raising the value of the property, we want to be able to maximize on it. Now, the first key component is obviously income as opposed to land value, or lease value, I should say. But as we're increasing the income, we want to get to a certain point where, the property, if we're raising 200 million as we are today, that the property is worth 400 million. And that's done based on future calculations of existing income and future drilling schedules. So as we raise the income to a certain level, we first want to be able to 2 years in. So 2 years after the last dollar is raised, to be able to sell a portion of the ownership in the fund to an endowment fund or a pension or retirement group that has a mandate for income. And this is very specific to our times. As we look at the difficulties in the bond markets and some of the other credit markets and interest rates, if we projected forward 2 years, it would be a perfect slot to have income from a high value commodity to be able to sell to these income needs. So that's one. As that's done, we don't lose any property or production. They're just simply buying out interest in the fund, which gets dispersed back to our shareholders. So our first objective is to be able to drive revenue in your hands every month. As the revenue escalates, then what we do is we look for an income buyer. And that income buyer comes in and shores you up in whole. So if we've already paid out $50,000 in MPI to you, we want to be able to get another $150,000 to return your $200,000 investment while you're still receiving monthly passive income. Now, that doesn't stop us from drilling. We continue to drill and develop PUDs. That escalates the actual valuation on the properties more for a true buyer of the fund to be able to come in and buy the assets and buy out all of the unit holders. That'll go to a large oil and gas company. And again, we're falling right into line with what the market is doing, because most major companies right now aren't drilling, they're buying back shares. So as we get 4.5 years deep into this fund, they're going to need to play catch up on their own production. So again, our first divestiture, 2 years after capital is raised, we're looking to sell to an income buyer to replenish principal back in hand. And again, we'll have another fund available 2 years from now to roll that into to avoid taxes again. And as the property continues to be developed, we'll sell to a purchaser, a working interest purchaser. And that's where the real multiple comes into play. And that's 3 to 5 years down the road.
if you want me to do an analogy to real estate, at any time, just let me know.
Please go for it. I love them. I'm trying to learn them. So
Right. So because they're so heavily multifamily guys, and I'm a multifamily guy, essentially what we're doing is we're buying these leases. So the secured asset's a lease, not land, right? And it's a development project. So and we're buying leases with, it's almost like saying we're going to buy a piece of land with a bunch of producing buildings around it that we have. So because we're going to buy in proven reserves, right? So we're buying a lease where we know there's hydrocarbons. Not only have we tested it, but there's a nearby or analogous, we call it, producing wells. And so we're going to buy these, and then we're going to buy multiple ones in multiple states. It's kind of like a diversified real estate portfolio. But before we buy them, we make sure that there's a bunch of pads ready to go for us to build wells on or build buildings on. You know, it's the analogy. And those are called PUDs. Use the word PUDs, proven undeveloped, right? Those are places that like, hey, we're buying this lease and we could put a well there, and there, and there. And there's a bunch of producing wells nearby our lease. So once we produce here, the people essentially renting from this building will spill over into ours because down below the surface, this pancake has these hydrocarbons and we're all going down to the same area, mile deep and a couple miles out, right? And so we're going to drill along this drill plan, as he said, in multiple states, going for a target of 50% oil, 50% natural gas. We have these income producing assets now, just like our real estate buildings, just like our multifamily apartment buildings. And just as similar buyers that buy those will buy that income producing things. But the interesting thing is once you drill, you get a third party valuation for the reserves. And then all of a sudden you're like, well, if I got oil and gas here, then now I've discovered all the next pads, the next highly probable PUDs to go and drill. And so it's like every time you drill, you prove the next market. You prove that the adjacent spots are more viable. And so once we've spent the capital to produce enough to sell off income generating assets, got your capital returned, we're going to continue to drill out all the leases. And then as we do that, we get more income producing, but we also develop all these new PUDs, these new places. We're eventually going to stop when we run out of funds. We're going to stop drilling. But we have these leases where we control all these high probable drilling sites. And when Eric says, hey, we're going to need to sell that to a working interest guy. In real estate, that would be like saying, hey, we have this pre-development done for all these communities ready to go. We need to sell it to a developer that can go drill or can build on all these pads that we have all ready to go. So that working interest is kind of like selling to another developer, another driller. And they're going to say, oh yeah, this is great. Let's sell this. And there's a PUD multiple. That's a proven undeveloped site multiple that you can sell based on the reserves and the nearby proven areas, the 3D seismic and all that. That PUD multiple that you sell that for, that's very analogous to a cap rate. It's a multiple used to sell an asset. And so we have similar kind of metrics in oil and gas. And so then we're going to sell that last piece out to somebody else. They're going to finish the drill pan. We're going to then go take our proceeds, exchange it for it into a new asset, and then start over. Did that help?
Try this. I'm going to try this, Patrick. So a PUD is very similar to a foundation. So it's, we have a piece of land and through the lease, and what we're doing is we're pouring a foundation, but not building the building yet. So a developer can look at our swath of land and say, hey, there's a lot of foundations and yeah, you can finish building the buildings. Here's the price. Very similar.
So proud of you, Eric.
Thank you.
It's more like a stoop to build scenario. To follow up with what Eric is saying, is what we're trying to do is go into an area, achieve economies of scale, and that will attract both potential income buyers and ultimately working interest equity buyers for a final sale of or way to recover our gains from the sale or the disposition of the property. One of the reasons why Patrick has selected our fund is because if you look at other oil and gas sponsors, in most cases, they give you, the technical name is a wellbore interest only. And at that point, you don't participate in the aggregation or the value of the PUDs that are being created. The only thing you own in a wellbore assignment only is the hydrocarbons produced from that well. So we have brought the concept of the multifamily possibilities of equity raising to the oil and gas industry as a sponsor.
So checking in with that, what does that mean? That means it would be equivalent to Sarah saying, hey, look, I got a multifamily property. You're going to invest in one unit and you're only going to get the cash flow of that unit. But you have to pay to renovate or build that unit, but you only get a piece of the cash flow and only if there's cash flow. Meanwhile, the entire building appreciated, but you don't get that upside. And so they're going to farm out each unit to a different investor. They're all isolated into their individual units and they only get a piece of that cash flow. That's how literally almost the entire industry is. There's virtually every other operator. We couldn't find another one that's offering anything close to giving you a piece of the upside of the secured asset, putting it in the fund, not only giving you the cash flow from dozens of wells, not just one, but then giving you a piece of that upside on the back end. It's the basic principles of a real estate investment applied to oil and gas drilling. Highly beneficial.
And I'm going to answer some questions I see really quickly because they're like easy ones. What is the hold time? So 3 years. So some people are jumping on, we already answered this, but 3 years is the hold time. Does it matter if we sign up tomorrow or sometime in March? As for, does it extend it? It's 3 years. Some people are asking, hey, what if I can't sign up by tomorrow? Is this fund closed tomorrow? So that has to do with the February bonus. And so you get extra points on the exit if you fund your investment by tomorrow. It doesn't mean that if you can't get your money in by tomorrow, you can't participate. The fund will be open until it's full. So I saw some questions about that, about how full is it? What if you don't get all the money? This is one of several funds. I don't think there's any risk we're not going to get all the money. People are so enthusiastic about this. But how long is it open? It's open until it's full. And your last fund, how long was it, Eric? I was an investor in that, not on the advisory board at that time, but it was like 4 or 5 months until it was full, or how long was it?
Well, we started raising at a difficult time. So we were raising right at the end of the pandemic where people were just kind of getting back on their feet. So it took us about a year to close a total, since I got here, a total of 50 million, but we've already closed 50 million since November 1st on this fund. So fundraising pace has really picked up.
There we go. Okay,
So
thank you.
I know that our first fund was under a 3 year, but my understanding was that we're just projecting 3 to 5 potentially.
Yes.
On this fund. So you'll look in the deck and it'll say, here's our plan in 3 years. But just like a multifamily, we want to tack a few years onto the back end just to, be safe. And without the presence of debt in the fund, it gives us a lot of flexibility to ride out any fluctuations of the market. So we're currently thinking 3 to 5.
Thank you for that. And you guys, I put in the chat a link to the data room. So a lot of your questions are bullet points in the data room. What is the minimum investment? $100,000. The PPM says 200, but for Invest on Main Street and Sugo Capital Investors, they said 100K is okay. So come on in if you have 100K to go. The 100K bonus and the 200K bonus are different. And maybe Eric, you could talk about that because I see a lot of questions about why is it different for the two? And then I'm going to bring the portal and show people how to use it. I think that'll answer a lot of other questions too.
Yeah, so rewinding back to what Rex was saying is that your traditional oil and gas deal, 100% of the back end, the sale of the property, the leases of the project, 100% of that normally goes to the oil and gas company. We actually include that for you as part of the real estate. It's why I'm sitting here. It's literally the reason I'm at this company, because I love the model. But in that, we also do have a split differential. So before we return capital, 80% of the net profits every month are distributed back to unit holders. After we return capital, it goes down to 60-40, and that goes through exit. So we take 40%, investors take 60% of the sale when it occurs. Now, investors coming in at 100, we're actually willing to bump that up to 65% on an individual basis through Sugo. And at 200,000, we bump that up to 70% on the back end. So as a sponsor in this fund and the operator in this fund, a bulk of our money is made on the back end. That's really where we profit highly. So as most people want with any fundraise, we want to close the fund as quick as possible. So we're offering and extending this this deal to incentivize folks to get in earlier. It just helps everyone in the end. And we saw a pretty significant increase in our expenses in 2022. We expect that to continue through 2023. So the faster we have capital in, our capital usually sits in our account for anywhere between 2 and 3 weeks before it's deployed into the field. So it's not like it sits here a long time. And we buy things out well in advance for the tax write-off and profitability. So the faster we have capital in the door, the more profitable the fund is. So we're just trying to incentivize folks to do to come in the door a little earlier, and we're more than willing and happy to do it.
And don't fall into the trap of waiting until April again to be reminded that you need to invest to offset your taxable income. If you do it now, you'll get a higher split, a higher return than if you wait until April or the last minute at the end of the year.
Yes.
And to clarify, because I see more questions on this, the cash flow for investors does not start at 3 to 4 months after the fund closes. It starts 3 to 4 months after they fund their investment, correct?
Well, it'll start for the entire fund in Q2. It could be anywhere between May. Middle of May is probably a good starting point as an estimate, but Q2, it depends on drilling. Excuse me. I mean, we drill, right now about 8,000 feet deep and a couple miles long in our wells. So it takes some time. We're dealing with Mother Earth. There are things that put on delay. There's supply chain issues that also create some delays. So we're not trying to be too predictive in the exact date, but Q2, mid to late Q2, that'll start for everyone who's in now. So you don't have to wait 3 to 4 months after our investment. However, there are some reasons behind the incentive as well. So as income is produced, we want to get folks in now, give you a bigger back end because you got to wait to make some income. We totally understand. I'm an investor in the fund. So is Rec. We all are. So while we're waiting for income to be developed, we want to give you an incentive to come in because you're going to weather a couple of months of the storm with us a little bit on the waiting game. But the price of units will also go up, usually after the second month after investment, to reward investors who are in early. So you'll get a great back end deal. You also have an appreciation of the value of the asset you've invested in. And we certainly want to get folks in to get a better deal now and have that reassurance that as soon as income comes into play, $220,000 or $200,000 units will probably move up to 220. We did this at the end of our last fund.
Mm-hmm.
Perfect. Thank you. I'm going to jump over to show you guys the investor portal because I think that'll also answer some of the questions around how to sign up jointly or with a friend, with a spouse, that sort of thing. So
while you're pulling that up, there's a question about reporting. They provide incredible amount of reporting. You get a statement every month with the exact proceeds from your investment from all the wells within the fund. It's like the last one's hundreds of pages. And then they do have quarterly town halls with the whole team from King on there, from the president, the founder, to the operations guys, the CFO, all there to answer any question you have. So it's definitely open book. Another question that kept coming up was, do they allow 401ks or qualified plans and IRAs? And the answer to that is no. And it's important that we say that. And Rex, maybe you can respond to that one.
So investing in oil and gas is unlike investing in real estate. The acquisition of working interest, which is what the partnership is purchasing for our leasehold assets, is deemed to be a trader business for oil and gas. And by investing in a trader business with qualified funds, the income that is allocated on that is treated as unrelated business taxable income, or UBTI, which would force the qualified funds holder to file 990T and pay the equivalent of corporate income tax on the basis of the funds being received by the qualified entity. So you do not want to do that because you do not want to incur a UBTI taxable event.
Cool. Thank you for that. All right. So you guys, I put the link in the chat. It'll bring you to this page. So most of you have already registered. If you haven't registered, you go to the link in the chat and you see the second highlighted words that say place your investment reserve here. Click on that and that will begin the process for you. So after you click on that, you're going to get an email from me. And in the middle of the email, it's going to look like this. It's going to have a big blue button in it. And the big blue button is what you're going to click on, and it goes to your own personal data room. It has your information. Of course, I'm like double signed in as multiple things. Hold on. Anyway, to start, you're going to click on that big blue button. It's going to bring you to your personal page, and there's going to be a green button in the upper right-hand corner, and it's going to say subscribe. You click on that, and that's how you begin the paperwork. I'm going to work on pulling up a different view. Can you guys hit on, because I see a lot of questions, which we did answer last Monday, but a lot of people are worried about the economics of this industry. So a lot of questions are around what happens if the price of oil drops, what happens, you know, with, you know, the war that's happening, a lot of things. What happens if, you know, the price drops, I see that a lot. And so, Eric, I thought it was really great. You said last week that the price is around 80 right now, and the fund would still be profitable if the price dropped to 40, right?
Yes,
So
and then that number could scale to 50. The economics for us, we won't really know thoroughly this fund until we get into the dirt. Our last fund economics are around 39 because we had bought a bunch of depressed properties from COVID. However, the reality behind being afraid of the price dropping dramatically is a far larger economic issue. So for the first time in decades, the amount of demand that's growing daily for oil and gas has far surpassed the existing supply. Now you'll get conflicting reports. You know, the EIA will tell you everything's fine. We have these, they use these terms and headlines that we have a huge inventory build of petroleum. But if you look at the numbers, it's 7.1 million barrels. We use 18.6 million barrels every day, day in and day out, just in the United States. So we're producing around about 11.8 to 12 million barrels per day for 18.6 in usage. There's a big spread just in domestic production versus domestic usage. With China coming back online right now, that is causing around a 4 million barrel per day demand spike in a market. So worrying about the price going down is certainly a concern, but it's not one that economically I would put too much weight on. Most analysts, including the conservative ones, JP Morgan and Goldman Sachs, are all expecting anywhere between 100 and 110 per barrel. Kupperman and Arnott are expecting $140 to $200 per barrel for the coming year. The way that we start is definitely not the way we finish in oil and gas. It's going to be a bumpy ride up and down all across the board, but we will certainly be profitable well below where we are in today's prices. That's why we do the business. We wouldn't even buy a piece of land unless we had a steep economic cushion between existing price and potential price.
Just a couple things to add to that. So the OPEC dialing back 2 million barrels a day, compounded with Russia 500,000 barrels.
2.5 million.
2.5 million.
Yeah.
And then in addition to China coming online, and the strategic reserves in the United States are the lowest they've been in 40 years now. So there's not a whole lot that the government can do because they've already depleted those reserves to try and even out the short-term shortage. And coming out of COVID, there's short in supply chain. It's sluggish for the larger players to get it back up and running. So although this is unfortunate for the global economy, right, to have such a shortage, it's a chance for us to take advantage of a super cycle in energy. And in the webinar, if you go through the deck that Sarah has, you'll be able to watch videos on Goldman saying that not only are we looking at very strong barrel prices, but we're looking at oil and gas commodities as being the strongest hedge against inflation right now. And it's a little egg on my face because I actually wrote an article in Forbes saying that multifamily was the best hedge against inflation. And over time, I'll stand by that. But at this season, you're going to see that that is a stronger hedge. So it's more than just the demand. It's where you're going to put your money to hedge inflation and hedge interest rate risk and geopolitical risk, because in a wartime, these essential needs are still required, right? When you see it harder to find good real estate deals and the stock market is down. And so between the shortage of the supply, interest rate, and inflationary measures all combined, it leads a pretty clear path to investing in that oil and gas commodity. And icing on the cake is the tax advantages.
Well, and this is my area of expertise, is the macro versus micro approach. So let me give you a simple as remedial example as I can, because the SPR, the Strategic Petroleum Reserve, is a reserve of energy designed for emergencies and wartime. And we actually just took another 26 million. So we're now at a 50-year low for the SPR. This is a reserve of oil we use for the military in times of war. So if we go to war, okay, which is at this point probably a strong possibility. But if we went to war, the SPR by law, legal manuals would have to be refilled in order to replenish the military. This would create another demand strain on the market. So while the government would have to go out and refill about 600 million barrels of oil into the SPR, that actually creates more demand in the market, along with China coming online. So the chances of oil going up versus oil going down are significantly weighted on the going up side from a supply and demand issue, not to mention the fact that we have multiple scenarios that are occurring around the world right now, with Iran is now selling China oil in yuans. That's a currency issue. That's a really big currency issue people aren't talking about. And OPEC is exploring selling oil outside of the US dollar as well. When you look at all of these things happening, you're looking at a massive mess that will only be cleaned up through energy. Everything revolves on energy. If you want to clean up the stock market, energy prices go down. But we have this big global event happening right now all over the world. And the biggest confusion, I think, because I talk to economists every week, and I've been arguing with them for 6 months, a recession and inflation, and you don't want to have, this is unlike anything we've ever seen before. We have never seen so many geopolitical conflicts along with economic confusion around the world ever before. So I think Patrick's totally correct that usually you would look to real estate as an inflationary hedge. Energy in this world, the time that we live in right now, is a huge hedge in these types of environments. And I will address, if you don't mind, since I'm on this topic, with green energy, how does this fit into green energy transition? Because it's a worthwhile question. You cannot make a solar panel without silver or oil. You cannot make a wind farm without oil or gas. You cannot charge a Tesla without electricity, which comes from natural gas, oil, and coal. So while the green energy movement is one that I think we should all support in the end, I think at the current moment right now, it's almost like it's like that toy that we all have kids on this call, all 4 of us. It's like you buy your kid a new toy and he plays with it and he spends all of his time on it for about 24 hours and realizes all the other toys are just as useful. We're really in that type of arena right now, where the logic being embedded back into the energy market is that green energy right now accounts for far less than 15% of the global production. That's just a fact of nature. So while we're in an energy crisis, a geopolitical crisis, an inflationary crisis, an economic crisis, and a potential war, there really is nothing more important than food, water, and stable energy sources. That is truly where we're at right now.
Thank you for that. Let's answer this question. If investors are GPs at the beginning, when does the transition to LP happen? And in the meantime, what are the risks of investors being GPs, especially if there's a lawsuit or something like that?
It's a great question. Can I answer this one, Rex?
Go ahead.
I'll keep it high level. If you need to dive in, I'll let you dive in. So as far as the GP to LP conversion, so the simple process of being a GP gives you a much higher weighted scale on year 1 taxes. As an LP, you would get the same 100% write-off, 20% a year spaced out over a 5-year period. So coming in as a GP gives you big year 1 advantage for the taxes. Now, all GPs, with the exception of the sponsor, King Operating, will be converted to an LP after the last penny is dispersed. So after the last dollar that was raised is put into the fields, at that point in time, the following January 1st, every GP becomes an LP. In order to mitigate the risk of a GP while you're in GP status, it's important to understand how oil and gas works. So as we drill a well, it's not just our company drilling a well. We use anywhere between 85 and 97 different outside contractors for each portion of the drill. Each one of these contractors comes with their liability and employment and all types of insurance criteria. In order for them to be hired by us, they have to be able to take on the liability for their portion of the drill. So while they have their own $20+ million umbrella policy covering the GPs, we also have a 20 million plus a $5 million policy covering liability for the GPs. So you're covered by two different insurance policies for each step of the way as far as the drilling, fracking, and all that process goes along. It's a very, very well structured plan. Did I do justice there for you, Rex?
Most definitely.
Want to keep it simple.
But I will offer this, the partnership itself is a separately named insured in our $20 million worth of general liability insurance, plus our $5 million worth of well control insurance.
Which means that it includes you, the investors. That was
Most definitely.
Yeah,
Yeah.
so that's the secret there. I think that the idea of being a GP somehow is, to some investors, scary. They're like, well, what does that mean? Well, if you look at the fact that you own your own home or you own a rental property, or hopefully both at this point, you're a GP, right? You're the sponsor, you're the owner operator. And if you sign on that property in your own name, and if you've gotten debt on that property in your own name, because you got a lot better terms if you do it collateralizing your own assets, then you have unlimited liability. Somebody slips and falls, something happens at your property, you can get sued. There's no limit to that liability. And so in the real estate single family world, single family investors, they take on the sponsor owner operator. On Sarah's deals in multifamily, you're a limited partner. You're in the fund as a limited partner in a securities offering. You're limited in liability to the amount you've been invested in the fund. You're not signing on any debt, right? So you're protected. Now this investment for a short amount of time falls somewhere in between, right? You're not on the single family side. You're not the operator, right? King is the operator. You're not signing on any debt because there is not intentions to have debt in this fund, right? So unlike what happened to me in 2009 and 10, when I was personally guaranteed on a bunch of pre-development, the market crashed and they came after me and everything I owned doing real estate, that is not going to be the case, right? So you're kind of in this middle area where you're still in an LLC. So if there's a liability, you've got some protection. You've got a $25 million plus umbrella policy covering you, which is mini X what the government requires. And you don't have to live your life in sort of this situation where you're on the loan and in debt and a liability place in single family. So for a limited amount of time, you ride in the GP protected by insurance, by a sponsor that has a track record, and also a sponsor where has never had an application where they've actually needed to exercise that. So it's kind of this stacked layer of protection that you get in the name of being able to get the tax advantages in the first year.
And remember that King is a 26-year-old company as a licensed Texas oil and gas operator.
I'm looking at all these answers. I'm trying to type while you guys are going through it. I'm afraid we're not going to get through everything. Oh my gosh. Okay, I'm going to share my screen again because I think if we don't get to your questions, I want you guys to be able to self-serve and find because there is an investor portal that has a lot of this. So in the chat, if you click in the chat, it'll bring you to a page that looks like this. So a lot of people are asking about the returns. So it states right here in the middle of the page, the 3 ways that investors get paid. And then there's a question about where is all of this happening? What states? So after you put in a reserve and you get your individual, actually I'll go to, after you get your individual link to go into here, there's a section called documents. You can click on that. It has a map in there. There's a business plan that has all the information, but there's just going to be a map that shows you where the different locations are. So after you put in a reserve, you'll get this email from me that has a big blue button on it, and you click the big blue button to start. It'll then bring you to this page, which is your private page. This one is for Andrew, and you're going to find the blue button on the page that says subscribe. You click on it and it begins asking you questions. Oh, come on, it just worked. But every time, it's because every time I show another screen, it logs me into like as an admin. I thought I had it ready to go. But that's where I really want to bring it up, because it's going to show you, you know, the questions around how do I subscribe with, because I see that, can I subscribe with my spouse? Can I subscribe with my daughter? Can I put a beneficiary? What I'll do, you guys, is since it's not working right now, I'll record a short Zoom, a short Loom, and I'll put it in the portal. That basically, when you click the button that says start my subscription, it's going to ask how you want to invest. So you can invest as an individual. So it would just be Sarah Sullivan. I put in my personal information, quick and easy. The second option in that questionnaire is joint. So a lot of people want to invest 100K in their name, 100K in their spouse's name. Make it a 200K investment and you can select joint. And so I put Sarah Sullivan, my social security, Theo Gogoli, my husband, his social security. It's a joint investment at the 200K mark. Now there is a place to put in a beneficiary if you'd like. So I saw that question a lot. And then other ways to invest. So we already talked about, can you invest with an LLC? There is a prompt in there to invest with an LLC or with an IRA. So Rex, you talked about that, but then we got a ton more questions saying, wait, so I cannot invest with my IRA or 401k? Is that correct? So can you hit on that again? Because we had some people join after you gave the explanation about, can you invest with an LLC? Can you invest with an IRA?
You can invest with an LLC. However, again, this is a gray area. You're limited, your liability to become a potential recharacterization of the active losses as passive, being subject to the passive loss rules, is a possibility, but only upon examination of the partnership by IRS, which is doubtful. Secondly, you do not want to invest through a qualified funds because it generates unrelated business taxable income, and the qualified entity would basically have to be paying corporate income tax on the funds that the IRA or other qualified fund may receive. So you do not want to do that for that reason.
So some people are doing it, but it's not our position to give you tax advice other than to say the most conservative approach is to do it in your own name as opposed to an LLC and then convert it to an LLC when we flip the GP to LP. That's how I respond to that. But ultimately, it's an argument that it's not really ours to give. It's just the conservative approach to do it in your own name.
Awesome. Thank you for that. Okay, I got it working, guys. So when you create, this is what I was talking about, when you're in there, how do you subscribe? So individual is the first one. If you want to have a joint account with your spouse, you click the second option, joint tenancy with right of survivorship. You want to have, there's going to be one primary and one secondary. So the legal name of the subscribing account will be, like, if I'm the one actually accessing this, I'm going to put my name. And then all this information, I'm going to fill it out as myself. And then I'm going to click add another owner. And then I'll put all my husband's information and then click next. So you'll see that there's other ways in this form, but like Rex just said, even though it's here, don't use, and we'll do an audit before we countersign and all that as well. So I hope that clarifies on that question. Oh my gosh, so many questions. All right, let's keep going.
That's a much easier setup than I have, by the way. I like that a lot.
Well, with the volume, we're trying to do it as automated. I mean, we want to be able to help you guys, but there's such a huge volume. We want to say, hey, like, look in there. This is how we do it. All right. So can you invest less than $100,000? No, you cannot. However, you can find someone else that you want to invest together with, and you can do a joint investment with your spouse or something like that. All right, another tax question. If one spouse has W-2 income, do you have to subscribe individual or under that spouse's name? Or can it be joint even if the non-working spouse still gets the W-2 income offset?
Before you answer this, Rex, I was kind of looking around on the Q&A as well. And there's a lot of questions with an assumption that this is only for W-2 employees. It's absolutely not. It's actually limited for W-2 employees. Self-employed folks, this is for adjusted gross income. So, you know, a self-employed person runs their own business, has a much higher threshold for the tax benefits, whereas W-2s have a limit of, and don't quote me on this, Rex will quote me on this, but 550,000 as a W-2, and there are no limitations for self-employed. So I'll just keep that in mind. It's not, if you're not W-2, this is actually a stronger tax investment for you. It's not specifically for W-2s alone. We're just one of the few that offer the same tax benefits to W-2 and self-employed.
Yeah, so 1099, K1, active income, passive income, everything that would lower your adjusted gross income.
That's right. That's right. Did I miss anything there, Rex?
No.
Sarah had a question before, but I forgot what that question was.
Mine? Oh, I'm trying to read and type. Can't listen. I'm going through and seeing.
Can we pull up the slide that actually shows the tax breakdown so we can review it? Because that does seem to be.
Yeah, go for it. You're all co-hosts, so you can bring up whichever
Okay.
slide you're thinking of,
I can
definitely.
share that real quick. Here we go. This is the kind of the big kahuna slide. Everybody always wants to see the tax slide. Having a hard time finding it.
You want me to pull it up, Patrick?
Sure.
And I'll answer some easy ones. Can we get Rex's company contact info? So King Operating, if you click in the chat, click on the link, register for the investment, you will see all the information about the company. Questions about wiring and how do we wire by tomorrow? Again, put in a reserve and you get access. We don't email the wire instructions. We're not sharing them in this webinar for security reasons. But once you register, you get access to the portal, and in the portal are the wire instructions. Everything is in the portal. So you need to register first. We're not going to email anything back and forth to you around the wire instructions for security reasons, for your own safety, etc. Because people can change that, as an attachment, and they can edit it and put in their account number, and then it goes somewhere else. And we don't. None of us want that.
It's for your protection, not to make things more difficult on you. We promise.
Thank you.
Yep.
Yeah.
And if it makes things easier, we have 11 people here that are on call. If you have questions, just reach out to Sarah. And if it's a question she can't answer, you'll have a dedicated person within King Operating that's helping you along here, along with Sarah as well. So plenty of support for you to answer questions.
Thank you.
So there's a lot of questions about this, and oh, geez, just flipped on me there.
Beat me to it, Patrick. You're much faster.
A lot of questions about this slide, and so I always like to present this where the approximation is that at least 75% of your investment would be intangible drilling costs, called IDC. You're hearing these new words. It's not depreciation. That's tangible costs on real assets that exist. This is a drilling fund, so we don't have a lot of that yet. In the subsequent years, we're going to have some of that on depreciation. But intangible drilling costs, we're projecting, if you invest, the funds come in this year, 75% on your K1, just like in a multifamily deal, become as a negative loss for you. Now that means, hypothetically, if you're making $400,000 or $500,000 a year, like some of our doctors and lawyers or entrepreneurs, and you invest $200,000, which is a full unit at that, and you had and we passed through a 75% loss, that's $150,000 that you would show up at minimum in that first year to reduce your AGI, your adjusted gross income, your ordinary income, all that. So if you made $400,000 that year and you invested $200,000 in this fund, then $150,000, that would reduce your taxable income from that, for most of our investors, from that $400,000 to the $250,000. $400,000 minus 150, $250,000. So that's a dramatic reduction in your taxable obligation. So if you're on a 40% marginal tax rate, 40% times the reduction, which is 150,000, that's 60,000. 60,000 on 200,000 or 30,000 on 100,000 investment. And that's where that number comes from when we say for most of our investors, if you invest 100,000, you're kind of all in after tax at 70,000. Now the projected returns in this fund, as we're showing, have nothing to do with that. They are not post-tax, they're all pre-tax. The tax advantage is simply icing on the cake. And then if you look at the lower, the MPI, there's so many words for this, but it's monthly passive income or mailbox money, right? It's your distributions that show up starting in Q2 is what we're projecting as your partnership. So, and then on that, as you can see on the asterisks down below, we have the IDC, which intangible drilling costs, 75% in year one. The remaining 25% will come off in subsequent years, as well as the depletion allowance and depreciation. So that if there's any questions on that, please feel free to throw them out there.
My only suggestion is this is a deduction to arrive at adjusted gross income, Patrick, not taxable income.
Okay, so it reduces your adjusted gross income by which, okay. Mm-hmm.
Can you bring up, I think it's the next slide in this presentation, the one with the projections, since we're still getting questions around, like, what's the difference between the cash flow and this one. So Patrick just talked about the first one, that a lot of people are saying, hey, for 100K investment or a 200K investment, what does the cash flow look like? So it's monthly. So what you see on the screen right here, I always look at the conservative numbers before I make an investment and say, hey, am I okay with the conservative numbers? The target high numbers are great, but what are the conservative numbers? So 14% annualized cash flow, people are saying, so what does that mean monthly? Well, maybe if you average it, it's more than 1%, but let's just say for rounding purposes, 1% per month, but you don't receive it in the form of 1% per month. It's going to vary each month. And so this number, 233,000, that is for a 200K investment. That's on average the expected amount per month. And then this 3.4x equity multiple, showing that your 200K investment becomes the 680K value after the fact. That 200K value does not take into account the tax advantages, but it does take into account the cash flow plus the profit at exit plus your principal returned back to you. Any questions about this and how the returns work before we go on? Because I see so many questions about it. So if you have a question about the returns, say now.
I saw some questions about 100K investment versus 200K investment. It is a straight 50-50 reduction. And we have a lot of folks who come in for a half a unit at 100,000. Sorry, I had to move. The sun was getting in my face. So I'm looking over here at one screen. But yeah, a lot of folks come in at 100,000 right off the bat. And then as income comes in, they'll add another $100,000 to their investment to get to that full unit. The projections you see there, again, they're projections. But our last fund was a total of 15.55% January 1 to December 30th of last year. That was definitely not paid in straight line. There were some really big months, some really thin months, depending on price and volume, but it's all designed to average out. So it's not a fixed income product. It's definitely a variable income product, but one that has tremendous upside, especially in 2023.
That's the hardest thing for multifamily investors. This slide it's very confusing for multifamily investors because they're used to buying stabilized income producing assets. When they see something like this, they're like, oh, the minimum's 14. It's not going to go lower than that. Oh, it's so, but that's not the case. Those specifically say targeted averages, and that's over the life of this investment. It's going to start small. This isn't your grandma's annuity. And if you look at the actual distributions on the subsequent slides of the prior funds, it's very clear. They go up and then they come down, right? And especially as we sell off pieces of it, you're going to see some reductions, and we're going to continue to climb. And it's not necessarily oil and gas prices rising and lowering. That's the only thing that affects it. When you drill down a mile and then you go out 1 to 2 miles, you're fracking along these lengths. And then you're going to get this larger production that's going to stabilize, normalize. And you're going to be doing that in multiple different states, multiple different locations. And as you build this, you're going to find a lot of ebbs and flows. The aggregation is going up for the most part until you start taking distributions. But you just need to be prepared for a little more volatility in the motion of that.
And it works both ways. You know, there's thin months, but there's no cap either. You know, if we have a massive well that comes, the income could be significantly higher, and it could be lower as well. Right.
This is not a diversification play for the lowest risk investment, or else you're going to be in a bond or an annuity, right? This is a diversification play and another essential need, hedging against interest rate, inflation, and providing for diversification in cash flow and appreciation, non-correlated to stock market, non-correlated to real estate. So you have a lower risk portfolio, right? Overall, not seeking the lowest risk investment.
All right, I'm typing away. I'm trying to get all of you. Questions around the deadline tomorrow that I'm seeing a bunch of, and you can definitely invest in March if you like, if you need more time for due diligence, but you will not get the February bonus percents on the back end. All right, what else do you guys got? Here's one about the tax. If you don't use it, I saw this a couple of times. If you can't use it this year, can you use it next year? Is it like depreciation where you can basically bank it till you use it all up?
No. Basically, IDCs have two treatments. You claim it in the year it was incurred when you make the capital contribution, or IDC is a specially allocated item that would show up on your K1 on line 13J of the K1, and you can elect to amortize it over 60 months, beginning with the month that you invest. So hypothetically, if you invested in February and you wanted to claim straight line depreciation over 60 months, you would basically get 11/12 of the allocated IDC for 2023. And then for the next 4 years, you'd get basically 12 months. And then in your 6th year, you would get the remaining month.
Can you say again too, since there's still questions, when does the timing of converting from a GP to a limited partner?
As soon as the funds are deployed, which we're anticipating the funds will be fully deployed by December 31 of 2023, January 1 of 2024 is when, pursuant to the partnership provisions, all the GPs convert to an LP.
Thank you. All right. If you guys see questions that you want to answer, let's just jump in and go for it. I'm trying to clear out ones that I think we did.
Yeah, there's something there about Excel sheets. The actual distributions from prior funds are shown in the deck. So you can go take a look. There's also stuff about what could the monthly passive income range to. Well, we've had months at 4% annualized, a month that was 4% annualized return. And we've had a month that was a 30% annualized return. But you can take a look at the actual distributions from prior funds to get a feel for that.
The real thing is when you drill a well and you place it in production, you're going to have quote unquote flush production, that's your highest rate of daily production that you're going to get. So that should generate a very significant MPI based on that. And basically we distribute approximately 50 days after the close of a production month, because that's when we as the operator get paid by the first purchasers who purchase the oil and gas hydrocarbons.
If you want to, I can round robin some of these really fast and save you some effort here, Sarah.
Let's do it. Let's do it. Go for it.
Okay, so I see a question here about the leasehold. So yes, leases are held by production. So we'll put some money down on a piece of land with a private landowner, and as soon as we produce, that lease is actually held in perpetuity, which is why the word land and lease kind of go hand in hand together. until we've produced, it's a lease, but once we have produced, we lock it in perpetuity. Is this fracking? Is there a possibility of fracking being outlawed? Some of our wells are fracked, not all of them. Vertical wells aren't always fracked. Fracking has a really misconstrued, misunderstood premise in the world as it being a dangerous and dirty thing. You can actually drink frack water. Frack water is just shooting high-powered amounts, large amounts of high-powered, high-velocity water and sand with some very light chemicals to break through, like using a baseball bat on a windshield just to crack a slate of rock in order to get to oil. Is there a possibility of it being outlawed? Well, let's look at events around the world. So they just unoutlawed or made it legal again in the UK to frack because supplies are so low. They're starting to actually open oil fields in Germany because so much money has gone into green energy that there's a serious supply issue. I do not see the possibility of fracking being outlawed specifically in states like Wyoming and Texas in ever. But there's always a possibility of laws that do things that go against the norm. So that's always a possibility. Will we be able to 1031 exchange outside of your company, say if a multifamily deal elsewhere or only into the type of asset class? That's a great question, and I can answer it with exact examples from the world. So we've had some of our investors in the past that have gotten proceeds and used proceeds via 1031 to buy apartment complexes in New York City. We also have one of the best 1031 people in the world right now structuring 1031s from real estate into oil and gas. So depending on who your QI is and how deep and detailed they'll get, 1031s can work on both sides of the fence. You want me to keep ripping through these with ones I know?
This is perfect.
Let me add one to that, the frack comment, because you combine fracking and drinking water. So one of the complaints I get is I don't want to be involved in fracking because I don't want to damage the drinking water. Well, the reality is, if you take a look at Sarah's deck, there's a bunch of stuff in there about that, and we're drilling a mile below the water table. So the entire idea of contamination of drinking water is a bit of a misconception. And in fact, I believe that the slide actually shows the 6 different ways in which we do this in a greener way, and that in the 2 million wells fracked in the past 65 years, there's been no confirmed cases of groundwater contamination due to hydraulic fracturing. So it is a bit of a misconception. I think that there was some situations with some guys that were misbehaving in Colorado that potentially contaminated some water a long time ago, decades ago, and caused sort of this political fear of this technology, which now has been regulated to the point, especially with players like King Operating that's been in the business for this long, and technology has increased to the point where, that's just a thing of the past. And we're well below having any effect on that. And it's just a political conversation.
Could be a thing of the future too, because most of the surface level drinking water is owned by one company, Nestle. So the future of drinking water will be underwater lakes. So fracking will be used to get to those lakes. That is definitely a thing of the future. You actually have a better chance of contamination from trains tipping over in Ohio, contaminating water sources than fracking oil. Very good point, Patrick. I understand that depreciation depletion can be used with W-2 wages, can also be used to offset 401k distribution. So 401k distribution becomes ordinary income less the penalty. So if you're under 59.5, you have a penalty of 10% for early withdrawal. So anything that stacks onto ordinary income, this will help offset as the AGI. So there.
Let me add something to that too, because I've had several investors say, look, I would really like to convert some of my IRA, and they're past that 59.5 to a Roth IRA. But I just don't want to do the ordinary income hit. Well, if in the same year you were to convert your IRA into Roth IRA, you would get an ordinary income hit. But if you invest in this deal, that can offset that ordinary income. Similarly, I have one investor that has a 401k. They're past 59.5 years old, and they want to get out of the 401k. They can't use it to invest in oil and gas as a self-directed 401k. But if he takes it as a distribution, because he's past the 59.5, that's an ordinary income hit. Then that can be used to invest in the deal as cash, which would then offset an ordinary income hit. So the tax advantage nature of this investment allows it to be part and parcel to a conversion vehicle within qualified plans, even though you can't use them directly to invest in this deal.
Good point. Good point. And we see it every day. I mean, we work with a group that does nothing but, IRA to Roth IRA rollovers, and they are one of our largest partners because they're using this investment to offset penalties and potential income. It's a way of freeing up your IRA. You can't, every penny you take out gets taxed and potentially penalized. Whereas this actually will create liquid income going into your usable bank account. I'm going to try to help you here, Sarah. I'm the concise guy here, so I'm going to run through these things. There's a great question. Sorry if it's been covered previously, and not to get political. However, my only hesitation here is that, in my opinion, this administration and policies are not supportive of domestic energy production. This coincides directly with the next question from Richard. How dependent is this investment on the government and shutting down or limiting pipelines? These are great questions to ask. So number one, we have very little exposure to federal land. We deal with private landowners and state owners. So we are in Texas and Wyoming. Wyoming is very oil and gas friendly. Obviously, Texas is as well. So in our particular projects, there's not a whole lot of risk of federal shutdowns. And I agree with you that this administration is attacking our industry. On the other hand, how dependent is this investment on government or shutting down and limiting pipelines? On the first, and I'm not going to get, and I stated this my first time, I'm an American. I'm not a Republican or Democrat. I kind of find that exercise to be futile. You're either American or not. America needs 18.6 million barrels of oil a day to operate. So at this point in time, the government has already shut down 25% of our industry. When you look at the Keystone XL pipeline shutdown, all of the federal land leases ending in some of the Dakotas, Utah, Alaska, the Gulf Coast, and the Atlantic. If they were to shut down another 10% of our production, our country would be in much worse condition than we are currently. I can't possibly see another restriction on domestic energy, considering that the administration is now talking about the importance of domestic energy after shutting down 25% of the industry. So there is that fear, but I just hope that logic prevails in these situations and that people realize it's not about what color you wear in your flag or your shirt. It's about the survival of this great nation. So, and that is dependent upon food, water, and energy, always has been.
And right now, Biden's not, with all this political risk, Biden's not saying, hey, let's turn North Dakota into a solar farm. He's saying, let's go to Venezuela and get the oil. So we're seeing the exact opposite. Even Elon, what you'll see in Sarah's deck, tweeted that we have to start increasing, he said, as much as I hate to say it, we have to start increasing domestic production of natural gas and oil immediately. So it is a major thing that the government's faced with, regardless of the politics. It is something that we have to start doing.
Yeah, and your average EV, just to make the battery, you need 800 barrels of oil to make an EV battery. You need to move 650,000 tons of dirt to get to cobalt and lithium. That's done with diesel fuel. You ship electric vehicles on boats that are run by diesel fuel. I don't see the same risk other people do, but I certainly understand it. I've just spent a heck of a lot more time in the weeds with it.
So some questions about the benefit of the promotion. It's substantial, and we really would like to incentivize people to spend the time, not to pressure you to make a decision before you're ready, but to incentivize you to prioritizing making the decision and becoming comfortable and asking the questions like you are here today in time for us to use that capital, have stronger distributions in Q2. And so what does that mean? The questions are, well, say we hit if we hit the 3.4 equity multiple on the nose, right? Exactly. And you invested in the promo period $100,000, then if you run through the math, that would equate to a $20,000 potential additional upside just for taking the time to decide to invest now rather than waiting for the splits to normalize. If you invested $200,000 and we gave you a 10% bonus on the back end, and we hit the 3.4 equity multiple on the nose, then that would equate to it was an $80,000. $80,000. So it's a substantial benefit to reward those that take the time to decide to invest now, What you'll find is that splits will normalize. And as soon as we begin distributing, we're going to increase the unit size because the fund will have appreciated. You wait till later and you're going to buy less and get a lower return. So it just makes more sense to decide to invest now.
And I see Andrea on here. Thank you, Patrick. That's a great explanation. I see Andrea on here as well, asking about compliance and regulatory issues. Yes, we absolutely have the resources and manpower. We've actually added about 6 people, maybe even a 7th person dedicated towards licensing, compliance and regulatory issues. That we can't operate without our license. That is primary objective. Number 1 is to maintain in compliance with all state and federal laws. So we certainly have that in place.
There's some
I'm sorry, I'm trying to rip through these here to save Sarah's about to have a nervous breakdown over here with all the answers she's getting out.
Well, good. You're taking the Q&A and I'm typing in the chat. So it's perfect. Keep going.
There's some questions about wanting to reach out and speak to King directly. You are right now. Right now you're speaking to King directly. Sarah has can get you in contact with a dedicated person that can answer directly questions. So reach out to Sarah, say, hey, I'd like to chat with somebody, and then she'll make a connection for that. And there's some information requesting the fund's track record. So as we mentioned before, King's been around for a very long time. This new diversified fund approach, the brainchild of the founder, has been around since 2015. And though the track record is in the deck, and you can see the actual distributions that led to the 3x equity multiple and the distributions for the subsequent funds that both Sarah and I are a part of in those funds. And so you can see exactly what's happened. Now that diversified at scale, dozens of wells, like dozens of units of multifamily to get that economy of scale and the de-risk across, including the leases across multiple states. All of that is a new, only King's doing it. There's really nobody else doing it. And since 2015, you can see the track record is all there, right there in the deck.
Yeah, I'm going to show you guys where it is in the deck. So when you get in, you'll see the screen that looks like this. This is the portal. It has all the information we've been talking about, the presentation from last week, and you can watch it on 2x speed if you want. Then in the top, you can see right next to overview, it says documents. When you click on documents, you can see there's a sample K1 that you can give to your CPA. So you can ask them any detailed questions that you have. Instead of asking us, we're not CPAs, you can take this K1 to your CPA and ask them about it. And then also this one that says Diversified Energy Fund Full Business Plan. That has the track record. It has the slides that we brought up. All of that is in there. The locations. So this is going to be really great for you to look at. Diversified Energy Full Business Plan. Like I said, it has the map with the locations. It has the tax benefits described. It has the returns described, and yeah, the track record. Someone was asking for an Excel spreadsheet, you know, with how the other funds performed. That is also in that document. So you want to jump in and review everything. It is available for you.
Correct. Rex, a question for you here. Is it possible to invest through an EQRP? Are there tax advantages and disadvantages of doing so versus investing with personal funds?
Again, our recommendation is to invest through personal funds. We have not had any investments that I'm aware of through QRP. So our recommendation is to invest individually.
So EQRP is another variant of the solo 401k. You're gonna have similar issues. It's just another brand of a solo 401k.
And the next 2 questions are kind of in line. For clarity, then the fund will begin to pay after it is full. So may start Q2. Is that accurate? That is not accurate. So the fund, we already started drilling and we'll produce revenue without being full. So we drill as we raise. We anticipate this fund to be closed in June. So there is some available time there, but income is not dependent upon the fund closing. If you invest today, you will receive the first distribution in Q2, just like everyone else. It does not have to be completed. Is the 3 to 4 month schedule for cash flow triggered by completion of funding? So those 2 questions kind of went together. Completion of funding has nothing to do with cash flow. We were cash flowing for almost a year before we closed our last fund. The best news is if you were in that fund for the entire year, you did about $31,000. And if you came in at the end of the year, you got way less. So always get in while you can. You want to be there from the very first MBI check to maximize, or first mailbox money check to maximize your total return. The lifespan of wells ranges from anywhere between 20 and 30 years. What formations are you drilling? We're drilling right now in the Permian Basin in Borden County. We're also drilling in the Bighorn Basin in Wyoming, and we are hitting multiple formations. So some of the things that are interesting for those of you who don't know is you've got a piece of land going this way, and that's Borden County, Permian Basin. And then once you get below the surface, you have different levels. We call them pay zones or formations that have either natural gas or oil or water. We're drilling right now in Permian. We're planning on hitting 6 different formations. So formations ranging from a few thousand feet below the surface down to 8,500 feet below the surface. Patrick was using the term pancake. We call formations or pay zones like a stack of pancakes. Each one has their own hydrocarbon, water, sand, whatever it may be. But each one of these drills are going to have different formations underneath the surface. Would you please speak more about John Malden's involvement and role in the fund of the company? Happily, John has texted me 4 times since we've been on this right now. John has actually dropped his broker-dealer license and come on as chief economist here at King Operating. So we have a 45-year track record of reading economies and seeing what's coming next. He's seeing energy, especially oil and gas, being so prevalent over the next 3 to 5 years that he's come on board with us full time. Of course, he'll still be writing, still doing his newsletter and books and television appearances. But John is assisting us in capital raising, corporate formation, divestiture, all across the board to ensure that we are not only executing things properly, but he's also helping open up some of the doors for us for new economics, whether it's bringing money in to drill or selling off land to the right partners. So John is involved with us. I speak with John on average probably twice a day in my role. So he's very heavily involved with us.
And John has been attracted to us because of the uniqueness of our offering versus what is available by other sponsors in the oil and gas space.
That's right.
In the
That's
due
right.
diligence we did, we didn't find a 2nd, 3rd, 4th, or 5th place as a runner-up to this fund. Not to increase Eric and Rex's head too much, but there literally is nobody else that even has close to providing the security and the asset, the diversification, the product mix, multi-passive income, return of capital, and a 1031 option at exit. There's nobody out there even doing half of those things.
And John's been fantastic for us. So, he actually had volunteered that he will do webinars on your behalf for you, Sarah. So if you need any help, you want to have John on here and talk about global economics, why oil and gas is important, I can get him on here for you. To me, he's Uncle John to me after all the time we spent together. So happy to go through that with him.
I think that's a great idea, actually. It won't be in time for the February bonus, but it'll still be in time for people to get in March who want to take more time to understand the industry and do their due diligence. So I'd love that intro, and I'll set it up.
Absolutely.
Thank you.
Is there any downside in the price of oil and gas as the economy may lessen demand, and how is the downside managed? So we do hedge to manage for downside pricing. Not just me, but I would think if you look at any economist in our space, we're kind of at the downside. Natural gas can't get much cheaper than it is right now without industries folding. I've got a very interesting article from the head of the Minnesota Federal Reserve, the Minneapolis Federal Reserve, talking about shrinking the economy to force a shrinking demand. There's a lot of weird stuff out there, guys, with things people saying right now. It's a very confusing time. What's important to understand in commodities, especially oil and gas, is supply and demand. In order for demand to be lessened, we would have to have some massive type of technology come into play in the next 4 days for that to take place, because you're seeing a gradual transition, which I think is going to be more gradual than most people anticipate over time. So I really don't see the prices dropping a ton from where they are now. But if they do, we do hedge. So we will profit on the downside as a fund, which you profit because you're a partner with us. If investing as an individual, is there a way to include a beneficiary or point to my living trust? Absolutely. I would definitely advise, we may have one of our individuals reach out and answer these questions, if that's okay with you, Sarah, to help them guide them in the right documentation or answer questions. There's a lot of folks on here. So
Yeah.
You have such a very good group and a large group that we built in a support mechanism for your group before we even launched. So we have that available.
And to answer that question, because so many people have that question, I will send out a loom to you guys to show you in the system how to make those, which boxes to select in order to do that. Eric, I have 3 questions, well, to team in general that I got via email that I'd love to throw in the mix. So are the returns on this investment more heavily weighted by the price of oil and gas or the amount of production?
Equally weighted. In the beginning, you'll have a larger dependency on pricing as volume is low. However, the reserves we have, right now, reserve calculations are $840 million in total reserves in these pieces of property. So the old saying is, I was an entrepreneur in tech space, and when you start out, you want to own 100% of your little project. It's better to own 6% of something large than 100% of something small. The same philosophy is true in oil and gas. It's better to produce 10,000 barrels a day at $60 a barrel than 1,000 barrels a day at $90 a barrel. The profit margin's there. So as an investor in this, you'll see that the increase in production weathers the profitability storm of price fluctuation. So early on, price is important, but over the next 3 to 5 years, we hope to offset that risk and that fluctuation volatility by producing as much as we possibly can. It's always the winning formula in oil and gas: produce more.
And the second question, I think we already answered it, but Terry, let me know if you need more info. What are the historical returns for this kind of scenario in terms of oil and gas production? So I don't know, I think we might need more clarity on that, but maybe you could say production for the previous funds.
Yeah, so our previous funds have produced right on track. So we always try to achieve 14 to 21% annual return. And last year we were on the low side. We got to 15.5. We had some great months when prices were high, some divestitures that 100% were dispersed to the shareholders during thin months. We also had a big raise at the end that diluted, and we actually paid our investors for the premium that came in late. So we always try to make sure that we're doing the right thing by our investors. We have no business without you, so we truly view you as partners. Historical returns, on the other hand, are difficult because every single swath of land has a different economic. So it's impossible to say what are the historical returns of a well. All wells are different, all surface areas are different, all subterranean environments are different, all drilling strategies are different. From a historical base, though, the easiest way to sum that question up is we shoot for that 14 to 21% return, and we've been very good at it since the beginning of this new model.
Thank you. All right, and then about the collateral. What is the collateral for this investment? We're used to collateral as a building, so is collateral land in this situation?
Leaseholds. Yep, same thing. So again, the leases, once we produce, are held in perpetuity. They act as ownership. And like Rex was talking about earlier, a normal oil and gas deal, to make it easy, a wellbore deal means you own the oil and gas that's been extracted from the earth. Whereas in our deal, the way that we work this is that you are an owner in the leases, which means that you own not only the production above the surface, but you own the reserves below the surface as well. So that is the collateral. There's a tremendous amount of collateral in this operation. And we haven't added a third property yet. So in the next coming months, we will add a third property that will increase the projections and the reserve, as well as the amount of leased land.
So that brings us to the value add strategy. Where in real estate, we're renovating units, increasing cash flow, increasing a valuation, right, of the secured asset. And in this particular asset, you get the lease. And as you value add, you add wells, you get greater cash flow, and you get the greater appreciation for the secured asset, right? The reserves, because you get the reserve report, as well as the future drill locations that are all collateral. So when you talk about collateral, you think about, well, that's for a debt, right? But so potentially we could call it a secured asset. What's the security, right, that you're buying into? You're buying a secured asset. Becomes collateral when you get a hedge for debt on it, right, to some degree, which we're not planning to do.
All right, just take anyone you see, guys.
All right, so it's with the kind of the same thing with the current anti-fossil fuel administration. The term fossil fuel bothers me because I'm pretty sure it didn't come from stacked up dinosaurs. But the fossil fuel administration, are there any roadblocks that can block drilling? Yes, if we were exposed to federal land lease. But if you look at the deck in our business model, our primary focus is private lease or private landowners and state landowners in Texas, Wyoming, Oklahoma, Louisiana, very friendly areas for our business. In this specific property, the well we're drilling now in Borden County, this is a unicorn. Not only does it have tremendous reserves, but there's also just one owner who owns all the mineral rights. In general, we'll look at land that has multiple owners, hundreds of owners of mineral rights, and it's kind of a mess, which is pretty normal in oil and gas. The property we're drilling has one private landowner, and he owns all the mineral rights on his own, as far as we can tell after doing our due diligence on the property. So very clean projects that the federal administration has no interference in the properties we're working on in Texas. Are there risks associated with this investment outside of the oil price? Is there a possibility of oil not being found as expected? Good questions. I think I've covered the risks outside of the price of oil. Additional ones would be, the weather, earthquakes, things we can't control, acts of terrorism. We're starting to see some of these things in the power grid part of the country, or all around the world, actually. So there's certainly risks that are involved. They're involved in everything. We can't really see annexing. We can't see any of that type of stuff because we're dealing with private and state-owned land. These are very highly protected pieces of property. Is there a possibility of oil not being found as expected? This is a tricky question. There is no possibility that there is no oil below the surface of the earth. 3D seismic tells us exactly where hydrocarbons are. However, there is a possibility always of not being able to get it out of the ground, a dry hole. So this is why we build portfolios. So you're not investing in one or two wells at a time. You're investing in a portfolio of wells. We actually had in our last fund, we had a dry well that we found out wouldn't produce the economics we were looking for about a third of the way in. So we shut down drilling operations on that specific well and transferred the budget to another well to make sure that we have increasing returns over time, because we get paid the same way you do. We get paid off of the exploration and production of oil and gas. What happened in the second fund? It was tagged as hard lessons learned. Great question. I can summarize it for you very quickly. We can do it in detail if you'd like, but we put that out there. We're not generally required to. We're human beings, and I think it's important to admit when we make mistakes and be accountable and to explain scenarios. So our second fund, number one, was going along pretty well, and this little thing called a pandemic hit. And it was difficult to get financing, people, operations, and the way that the price of oil was going was below $39 a barrel. It was not profitable. We also had taken on financing from private equities via debt. The hard lessons we learned were not to take debt and to go all equity and not have any interest rate fluctuation or volatility. But we also grandfathered our investors into the next fund. So we made sure that we shored them up. We transferred assets and investors from one fund to the other. But it became just like every other. I mean, I own my own business in California as the pandemic hit, and I lost 91% of my revenue in the first 6 weeks of the pandemic, and it would have taken 4 years to recoup. So it's just kind of a cut bait and learn lessons type model, and we transferred every investor who was eligible and all of the assets that were eligible for movement into the following fund, and use new proceeds to buy very depressed properties because of other operators going through the same scenario. So. We got dealt lemons and we made lemonade as best we possibly could.
Let me highlight that, because part of our due diligence always on a sponsor is when things went south, what did? They crawl in a hole when they had an opportunity to get out and say, hey, well, investors, you signed the PPM, you saw the risks, you lost it all. Did they do that? Or did they get creative and did they fight their way through and make their investors whole? And so while the pandemic happened, it wasn't anybody's fault, right? It just happened. But what did Jay Young do, the founder, right? He's got over 20-year experience, got a reputation to uphold. He dug in, he took his fund, he said, look, we got to stop operations, right? And there was a couple pieces to that. One, not only did it have debt, but it was isolated into one county. He said, look, in the future, we're going to do diversified fund into multiple counties. And we're going to go for more drill-friendly locations too, because there was some issues with that side as well. But tell you what we're going to do, we're going to stop. I'm going to look at this as a positive because I'm going to go pull money out of my own pocket, right? Which is what we all look for our multifamily sponsors to do too, to make good. If the funds are needed, let's have them pull out of their own pocket. He did that. He went and purchased distressed assets. And then, as Eric was saying, instead of saying, hey, get lost, rolled them all forward. And actually, as Sarah and I both are invested in that fund. And that fund that now those investors are seeing a 19%, what was it, a 19% so far annualized return or return on investment so far in that fund.
15.5, yeah, 15.
Yeah. Last year though, but overall, I think, right?
19.5.
Yeah, it's 19.3% from inception, which began June 1 of 2021 through February.
Right. So that story that we just talked about where the pandemic hit and all hell broke loose, the whole world stopped, our product demand collapsed. Those investors have received a 19% return on investment. That is a really good story because the sponsor came out of pocket, held his reputation together, and made good by their investors. Great story.
Yeah, he came out 3.5 million. I mean, he really did put it in play. Another great question. What about the outlook for gas? Since that price is much lower than your projected price, aren't you expecting this fund to be 50 oil and 50 gas? The story of natural gas is probably the most confusing economic story on planet Earth right now, because the price of natural gas in America is $2.5 or $2.50 per unit, but in Europe it's $30 per unit. 30. So if you look at our last GDP, you'll see that a major part of our GDP was derived by selling American natural gas to Europe at a major profit. We're probably going to see that again on the next GDP. But you know, there's stories to be told there. Economics will tell you the weather isn't as cold as it should be. That's not I don't care what John says even. That's not a viable opinion to say that there's a 65% drop in the actual price of the commodity. Something is happening there where our nation is buying our inventory and selling it to Europe and calling it a profit. What are we doing about it in the process? We're focused on oil. So as soon as that price correction comes back into play, 100% of our drilling activities right now are geared towards petroleum. Now, as the price of gas rebounds, we have 4 frac projects we can kick off in our last fund right away that we put on hold, because it wouldn't be worth the economics to gain even a penny in revenue at this price. So we're focused in on oil, primarily, especially in Borden County. That's an oil heavy project. We have Wyoming slated for April or May. And we expect, we're not hoping, but we expect pricing to be back in the $4 to $5 range. You know, we were over $9.25 a unit in this country until about 3 months before midterms. So that's kind of where we sit. Oil and gas is very sensitive to geopolitics, by the way.
But let me point out, I mean, the whole purpose of this fund is to allow us the ability to pivot. So we're not locked into 50-50 split. We have purchased leases and we have locations and the optionality to pivot between the one. We can focus on the ability to produce half oil and half natural gas. But just like today, the beauty of this fund is because you didn't invest where there was a 1 oil well assignment or 2 or 3 oil well assignments and you were all in one commodity. Now you're balanced between the two. We have the ability to pivot between the two. Right now is the testament for the reason why this is a good investment, because we can do exactly what we're doing today. And in the last fund and this fund, we're seeing King pivot in real time to make the best return possible based on these 2 commodities and how they're trending.
Absolutely. Well put. Well put. Very confused.
And our technical team is superior.
Yes, 100%.
There's no other investment in oil and gas that has this ability to have the ability to pivot between the 2 and hedge between the risks of the rise and fall between those 2 commodities.
Yeah, a couple of things we haven't even talked about. We don't sell our product through futures, so we aren't obligated to drill one thing or the other. We own our inventory in full. We also own all the I guess you'd say, a lot of California people, the creative rights. You know, coming from LA, that's the term all writers look for. We have full right of refusal to modify our drill plan any way we see profitable. And that key word is profitable. If it's not profitable in gas, we focus on oil. If gas becomes more profitable in the future, we'll invest more capital into that arena to drive higher revenue as well. Oh, go ahead, Patrick.
There's a question here. Return percentages, are those net of the 80-20 and 60-40 split, or are these split with King? No. So all the returns in the deck are net of 80-20 and 60-40. And there is a specific calculation where you can flow through how the dollars come in from the return of capital split 80 and how the dollars come in to split 60. And then at the bottom line, how the 3.4 equity multiple is calculated. And then on the asset slide, it actually does here's just of the two leases we have today, how the total 3.4 equity multiple is calculated. So all the information is there in a deck. And if you have any more questions, we could certainly answer that one for you, David.
Good question, by the way. And just, I think we have people popping in and out. Yeah, the IRA is different than treated much differently in energy than it is in real estate. We do not advise using IRA money. I see a couple more of those questions popping up. You guys have a lot of good questions. This is great. Can you help me understand how the putting together the offering and the marketing costs of $15 million accrue? Well, this is Rex's structure and design, so he can help you understand the marketing costs along the way. So I'm going to give you that question, Rex, and then we only have 3 more. The other one for Rex is, does the tax write-off work against capital gains? I think those 2, and then that's it. So
before Rex answers the marketing one, that one threw me off because as a multifamily investor, you're not used to seeing numbers like that. And we went deep when we had a couple of weekend long calls with Rex to really dig into the overhead associated with being present in 5 locations in 5 states and 7 basins, and having operational individuals, the overhead associated with carrying a development oil drilling company forward with geologists and all the individuals over the life of the fund. And so they have a section of this in the front, which includes the ability to carry the overhead forward of the organization across it, which is a little more equivalent to an asset management type fee that we might see in the multifamily space, which is the fee required to manage the organization to execute a highly complex, diversified drill plan in 40 different wells. And so all of that is what's kind of wrapped up in that. Right, Rex?
Yes, most assuredly. You have to understand that we are very, very, very specific with both our land team, our technical team, and our financial team to go in and analyze anywhere from 15 to 40 different possible leasehold acquisitions before we find that unicorn opportunities, as Eric was describing, to select that particular group of leasehold assets to put in a particular fund, because we believe that what we're trying to put as assets of our sponsored programs have specific uniqueness. For instance, both programs have 3D seismic that's already been shot and interpreted. Also, in the case of Borden County, there's one landowner, one surface owner. That is very, very unique. And to be able to evaluate the number of possible leasehold acquisitions, and just our company has grown basically from 10 to 43 employees over the course of the last 12 months. That capital requirement is a function of, as Patrick says, making sure that we can properly fulfill our due diligence and our fiduciary responsibility to provide the best, most successful managed partnerships possible.
And then I can answer the last 2. Does the tax write-off work against capital gains? I'm going to try this though. Go ahead, Rex, but I believe the answer is no. It's adjusted gross income.
Well, capital gains arrives at adjusted gross income, so the answer is truly yes. The real issue there is our partnership is generating basically ordinary losses that ideally would offset 40% tax rate dollars. Capital gains is at 20% tax rate dollars. So if most of all your income to arrive at adjusted gross income is capital gains, you're not going to get the full effect, because what you're trying to do is offset the highest marginal tax rate that you have, which most of all accredited investors are generally in a 35 to 40%, or if you're in California or New York, you're probably in a 55% marginal tax rate, maybe. But Patrick can speak to that for sure. So what we're trying to do is our ordinary losses will offset any form of income that is calculated to arrive at adjusted gross income. The only negative with trying to offset capital gains is, again, you're trading possible marginal rates of 40% to 20%.
Correct. The last question, I think we're there. From Jen, you mentioned you drill on leased private state land. Do you do horizontal drilling? Does horizontal drilling intrude on the land that you don't lease? Just trying to see if it's a risk. Number one, yes, we do horizontal drilling. It's very profitable and a much higher rate of return than vertical in certain instances. Again, everything is different based on the land, the subterranean setup. We will absolutely never go beyond our lease drawn line. That is inviting lawsuits. We will never do that. We have never done it. We'll never do it. However, there are instances with certain types of subterranean structures that do allow leakage, but it's not from us. It'll be the ground. So imagine, instead of a pancake, a hamburger with a hamburger, cheese, and bun, and there's relish. Mississippian chert is like relish. It's a bunch of particles stuck together, a bunch of broken rock held together. So on occasion, drilling through that, you could be causing leakage from other property into our land, but legal, it's 100% legal. Nothing will come from that. We will never run pipe on land that we do not have legal access to ever. That's certainly not something that we do.
Well, it's a whole lot part of our intention, because we're drilling in areas where there's nearby producing or analogous producing wells. That's one of the major strategies. And we're looking to carry forward, kind of piggyback on work that's already been done in a big way.
Correct.
Well, one of the major things that directs us of where to put a particular oil well or choose a particular PUD to develop is control of well, where you have access to all of the logs and geophysical and geological properties that's in that area, as well as 3D seismic that has been interpreted.
124 questions were answered.
Well, that was just in the Q&A. Then there was the whole chat and
Right.
other messages people were sending. There was one more, and we did talk about it, but it was still asked again recently. Can we talk about, have we ever dealt with any lawsuits, and what would the investor's level of risk be if there was a lawsuit?
Well, Rex has been here 15 years, so I will certainly let him answer that question.
Well, in every business, you're going to have technical issues with vendors and with other people that want to acquire leases that you own. So yes, there have been some minor disputes on that King has incurred over the last 26 years. But one of the wonderful things that we have is we have just added Nathan Myers, who is one of the 300 licensed oil and gas attorneys in the state of Texas. That's a very, very unique designation. And he is handling all of our legal procedures and putting together standard operating procedures to mitigate any potential loss. But if we are sued, King is responsible for that, not any of our investor partners.
Thank you for that. And Steve, your question, I'm sending you another email. And so you just click on the blue box in the email and it'll take you to your portal. And then you click on the documents tab in there and you'll see the business plan.
There's one in here that is a good one. It's for electing to extend the IDC forward for 5 years or 60 months. Does the amortization then go across the full 100% of your investment, or the 75% in the first year that you would otherwise have?
So if you look at the sample K1, what you'll see on the sample K1 is basically there's 3 different numbers. I'm not sure that one of them may not show up in that, but basically there's deductions in box 1 and there's deductions on 13J. 13J is the IDC, which again is a specially allocated item. And that is the portion that you would elect to allocate over the 60 months. And generally that out of the first year deductions, the IDC represents somewhere between 75 to 85% of the 75%, and the tangible deductions and other ordinary deductions, which are reported in box 1, represent anywhere from 10 to 20% of the 75%. So basically, if you're looking at the 75%, a simple way of looking at that is IDCs is like 60%, and the ordinary deductions, which includes depreciation, is 15%. Or it may be 65-10, but that's how that basically breaks out. Majority of it is all going to be IDC.
So there's another question here about the 1031 exchanges. And if and can you speak to a 1031 exchange rep? Reach out to Sarah, and Sarah can get you in contact. Maybe there's a misconception with Kim here. This is not a fund structured for you to sell real property and trade real property into this fund. Second half of this year, we're working on putting together a fund which will allow for the exchanging from real interest in this fund and the last fund into it, as well as real property exchanging. So you sell your rental, your land, and then trade it as a 1031 exchange into that fund. But that is not part of this fund. And we'll let you know sort of second half of the year once we have that push. So right now, this is primarily a cash investment. And we can look at 1031 exchanging you forward from this investment to a subsequent investment. Second half of the year, look at selling real property and trading it into oil and gas interest.
And, I had someone, and they worked it out with their CPA, that it was better to, when they sold their property, they were like, oh, okay, so I can 1031 exchange into, some other real estate, or I can take the hit, but take the money and invest it in this, and get the tax advantage, and the returns are so much higher than you would get going into a single family home 1031 exchange, or any syndications that you see available right now. So they were like, actually, if I just take the hit and then invest the money in this tax wise and total return wise over the next 3 years, it's better to do it that way. So also talk to your CPA about, hey, maybe it's better to just take the tax hit and do this exchange, do this investment.
100%. And that's on the theory of a conversion vehicle, where the tax advantage of this, if you talk to your CPA and you're selling a property and your capital gains are manageable, just like if you sold part of your stock portfolio to trade into it, you're hoping for a rebound in that. Well, the tax advantages in this provide for that rebound. If you're selling real property and you get a taxable hit, depending upon what that taxable hit is, just a tax advantage alone might rebound you from that, right? So it depends on you got to talk to your CPA, but this is a really powerful conversion. If somebody else in here about doing the Roth conversion, that's a really incredible way. And if you're past 59.5, pulling money out of your 401k without the penalty, this is an incredible way to do that as well.
Even when income is available, the penalty is also offset by the income. So we work with a group in Florida that this is all they do is qualified plans, getting out of qualified plans, Roth conversions, even 1031s. I don't like to say it, but it's actually the best product in the world to get out of the constant 1031 loop into something different, and to get your money from qualified plans into something that produces liquid cash in your bank account monthly.
Especially since conservation easements
Yes.
have been abolished now. So.
All right, well, I think we made it through everything. So thank you for all the investors who are still on here. Man, 2 hours of Q&A. I hope we covered everything. We don't have any open questions. Eric, Rex, Patrick, thank you so much for being here and spending 2 hours of your time to make this really efficient. And I think it's great for investors to see what other investors are asking. So whether or not it's efficient on our time, I think it's efficient on the investor's time, because it really expands the due diligence that they probably would have done on their own. So I appreciate you guys being here and making the time for them.
Absolutely. Thank you, everybody, for having us. We really appreciate great questions. These are really good questions.
Yeah, happy to be here anytime. Really impressed by how active and inquisitive and thorough the questions have been. It's probably the most thorough Q&A session I've ever been in related to this fund.
Thank you for the
I always drill
opportunity.
in due diligence. You got to do it.
Yeah. Mhm.
What was that, Rex?
Thank you for the opportunity.
Oh, yeah, thank you. All right, everyone, this recording will be placed in the investor portal within the next few hours by the end of the day. Also in the portal, for those of you who have registered, your wire instructions are in there. So if you already made a decision, wire this afternoon, wire tomorrow, and you'll get that February bonus. If you want more time for due diligence, you can invest until the fund is full, but we're looking to complete that in the next 30 days or so. Any questions, shoot me an email. And thank you again, everyone. Have a great day.
Thank you, everybody.
Thank you.
Bye-bye.